We did see the markets react just a bit, but still pretty close to highs here, Steve Grasso. So what do you make of all of this?
Yeah, I think that people, if you look at the response time that all of these stories that they've taken to be digested with the market, we've all been around long enough, right? The financial crisis, trade crisis, dot-com bubble, COVID, all worked through more rapidly with every consecutive crisis. So I think the market right now has moved on and said, this is probably just the sausage making in the process. So we're just going to buy the market and go to where the puck is going.
I mean, at the same time, there's also this July 9th deadline, and supposedly we're closer to a deal with the EU. Both sides have confirmed that. But still, this whole thing, this is our northern neighbor. I mean, right now we're working on under exemptions with USMCA.
Well, as it pertains to interest rate policy, I'm hoping that he means 1% real rates, because given that we just had a PCE reading slightly over 2,
I'm guessing it's not real rates.
Well, I'm just trying to take the moral high road here and give the benefit of the doubt, but it's perhaps it's undeserved. As kind of as you said, I'm hoping here that this is like essentially a way for him to push back against the taco trade and perhaps present himself as being a hard and fast negotiator with a very close a neighbor of close proximity and doing this, because what we've seen is a delay, and it's more likely, to your point about a July 4th or July 9th deadline, that's likely going to get pushed out. They've already given themselves runway to say, okay, it's not really a big deal, we're willing to extend. So I just think this is them bringing in another pillar and saying we are willing to be tough negotiators, because their recent history has suggested that they will continue to kind of acquiesce and provide flexibility, and I think that's kind of undermining a bit of their credibility.
You know, Mike, we started the show with this trade stuff because of the uncertainty, and in spite of the uncertainty, we're hitting record highs. So what does this tell you about the durability of this market rally, in your view?
I would say that it seems like you sort of hold your nose and buy it, actually. I mean, I was a little bit concerned, I have to say, when it looked like we had opened at fresh highs and then it looked like we might actually be heading lower, which it did with about an hour before the close. We did see the market actually get, to negative territory. And I actually lightened up a little bit there, because technically that just feels terrible to me. When you open at a new high and then close lower, that's usually the kind of reversal you don't like to see. But, people bought that dip. And, I think the confirmation we had that the market was in good shape came when XLK, when the technology stocks broke out to fresh highs first. And, of course, they've been market leadership, so you kind of expected some of these other things to follow along. And a lot of the news has generally been pretty good. With respect to Powell and all of that, I think there's a lot of bluster there. It's not in the dual mandate for the Fed to try to help out the fiscal debt and deficit situation, which I think is really one of the things that Trump is kind of upset about with respect to rates.
Yeah. Carter, what do you make of the technicals behind the S&P 500's move?
Yeah, well, to Mike's point, if we had, after the reversal, had closed at or near the low, that would have implications. But in the last, it shook it off and it was a decent day. But really, there's two stories to be told, right? And the first is that the market today recouped its losses associated with essentially tariff or tariff-related news and is now back to where it was, and simply that, right, on February 19th, and an inch above. How much above? We're 42 basis points above where we were then. So what that narrative is, that the market in 4 months is up 42 basis points. That's an annualized rate of 1.2%. That's quite dull. The other story is, from the April low, of course, the lows of the tariff news, the S&P 500 is up 28% in 2 months, and it's annualizing at a rate of 203%. So you can tell any story you want, right? We're annualizing right now from the April low at an annual rate. We'll be up 200% if we keep this going. Oh, but what about the fact that we're up 1.2% over the past 4 months? We're annualizing at 1.9%. Both are true, and therein is the conundrum. Are we putting in a double top? There's a big prospect for that. Or are we going to clearly break out and make new highs? It's anybody's guess. I don't have the answer to that.